Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Here's your U.S. markets wrap with me, Ryan Huang. Not a great session last night, rather lackluster. For the S&P 500, pretty much flat as investors grapple with fears of rising rates and worries about a ballooning U.S. deficit. And we are seeing the 30-year Treasury yield hitting their highest levels since October 2023 as lawmakers pass a bill that investors fear could worsen the U.S. deficit. The Dow Jones Industrial Average slipped over 1.3 points, closing at 41,859. We have got the S&P 500 down 0.04%. And the Nasdaq Composite on the other end of the spectrum, higher by 0.3%. Let's check in now with Dilin Wu. She is the research strategist for Pepperstone. Dilin, good morning. How are you doing today?
Good morning, Ryan. I'm good. How are you doing?
Doing great. Happy Friday. Lots to talk about these days with markets getting a bit nervy. And of course, right front and center is what's been going on for the good part of this week. That downgrade from Moody's on the U.S. credit rating from AAA to AA1. And then now you have more nerves coming forth with what's playing out with the U.S. deficit, with the passing of a bill that could worsen the U.S. deficit. So how significant is this? How much should we worry about this?
Well, as we can see, risk of sentiment showed up instantly in the market. Treasuries are once again showing signs of weakness, with the 30-year yield climbing to as high as 5.15%. And U.S. equity futures have paired early gains and now are hovering near flat. We have comments from Fed Governor Waller about markets wanting more fiscal discipline didn't help either. I mean, it may be true, but it's not exactly what investors want to hear right now. And I feel like maybe it's too early to draw any conclusions, but I can't help but wonder, if we are at the start of a familiar cycle. I mean, bonds break stocks until stocks fall enough to force a rebound in bond. So that's a major concern of mine. And this kind of increase in term premium means investors are demanding higher compensations for holding these longer maturities. For the stock market, that means rising interest rates, or I should say discount rates, which usually translates into lower stock valuations.
Yeah, I'm just looking at the bill, and this involves tax cuts, also increased military spending. So it seems like you might actually get some tailwinds from this, no? At least the companies getting some benefit on that front. Would that help to offset some of the concerns?
Well, I wouldn't say increase that or, by Moody's forecast, a U.S. fiscal deficit reaching 9% of GDP is a good thing. But assuming no U.S. default, I don't think so. They can print money anyway. So the fiscal deficit can currently help somehow still stimulate growth, employment, consumption. So the stock markets tend to trade on the near-term outlook, maybe the next quarter or the second half of 2025, rather than economic expectations for 10 or 20 years down the time. Nobody care about that at the moment. So with the midterm elections approaching, it's unlikely that the fiscal deficit will improve significantly in the short term anyway. So, yeah, I wouldn't say increase in that is good news, but yes, it has its reason.
Okay, let's talk about what could be moving markets next. And all eyes on NVIDIA with their earnings update next week. So far, we've been hearing from Jensen Huang, the CEO, saying how currently restrictions have been in some way backfiring because they've lost market share in China. What do you make of this, and how much is this potentially going to move markets?
Well, actually, NVIDIA is an important report everyone is looking for now, and it will come out after the market close next Wednesday. So the stock has already rebounded nicely from its early April lows. And with the new, U.S. AI diffusion rules and strong AI capital spending expectations from big tech companies like Microsoft and Google, NVIDIA's earnings report is definitely worth keeping an eye on. And the market is guessing whether the company can meet revenue and gross margin expectations, EPS, and what guidance it will give for the next quarter. And I feel like this kind of impact is quite significant in terms of the chips export and the chips demand. So I feel like if NVIDIA beats expectations and Jensen provides a positive outlook, delivery outlook, and demand outlook, it could give a significant boost to NVIDIA and also Nasdaq.
Yeah, also, I guess worth watching out what's playing out in China with the ongoing US-China trade tensions. In particular, the Seng index. We've seen a couple of things playing out. Easing of tension somewhat. The can being kicked down the road with the suspension of tariffs to some extent. I have also seen 2 rounds of stimulus measures from Chinese authorities in the past month. But we haven't really seen the Hang Seng index rally as much as some would have hoped. What's going on here?
I feel like China's economy remains in the two-speed growth mode, while lower tariffs support exports somehow in the future. Stimulus measures have yet to significantly boost domestic demand or revive the property sector, as we can see from the April activity data. So that left investors in the wait-and-see approach. From my perspective, I feel like while tariff levels may not be more negotiable to both sides, uncertainty lingers as the U.S. could ramp up pressure on, like in other strategic areas, for example, some non-tariff barriers. But I still leaning towards the Hang Seng index to the upside is because given China's price level are still low and PPI remains negative, it's definitely room for more monetary easing. And with both domestic and external demand uncertain and economic pressure not fully eased, I think there's still potential for the LPR or the RRR to be cut again later this year. And on the tariff negotiations, since both sides have already made concession on tariffs exceeding 100%, it's unlikely we'll see tariffs return to those heights. So yes, I'm still quite bullish in regards to the Hang Seng performance in the mid to long term.
All right, talking about bullishness, we've seen a lot going on with gold these days. Year to date, up more than 25%. For the past 12 months, up more than 40%. How bullish are you right now on gold?
Well, I am still quite bullish, of course. And I feel like one major factor behind is Moody's recent downgrade of the U.S. credit rating. And on top of that, we now know the U.S. has just passed a tax cut bill. And in the short term, these factors tend to increase safe haven demand. And over the medium to long term, the ongoing build-up for gold reserves by global central banks, especially the central banks from those emerging markets, will continue to support gold prices. So I feel like both aspects are quite positive for gold. And I would say China's demand is also significant. According to the latest customs data, China's gold in April hit their highest level in 11 months, soaring 73% from March. And the strong kind of demand for physical gold from both Chinese institutions and retail investors has even prompted the PBOCs to raise the import quotas for commercial banks. So I feel like, yes, the least resistance of gold is still pointing to the upside from my personal perspective.
All right. Right now, gold trading at around $3,290 per ounce. So perhaps some opportunities to buy on the dips. And in conversation with us this morning, Dilin Wu. She is a research strategist for Pepperstone. Dilin, thanks for your time this morning and wishing you a great weekend in advance.
Thanks, Ryan.
All right, we'll catch up again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.